Welcome back, everyone. Today, we're popping the hood on one of the absolute most complex behind-the-scenes mechanisms in international finance. We are exploring the mechanics of global transfer pricing. Over the course of this explainer, we're going straight into the hidden gears of multinational corporate taxation to see exactly how massive companies allocate their money across borders and how governments scramble to keep up.
Millions of dollars. We're not just talking about saving a few bucks at the margins here. The technical pricing strategies we're about to break down can legitimately result in tens or even hundreds of millions of dollars in corporate tax savings. It's a high-stakes, highly sophisticated realm of accounting that quite literally shapes the financial reality of the global businesses we interact with every single day.
So, here's our roadmap through this cat-and-mouse game. We'll be looking at profit-shifting mechanics, the arm's length principle, documenting the trail, avoidance rules and APAs, and we'll wrap things up with pricing methods and careers. Let's get right into it.
Section 1. Profit-shifting mechanics.
Okay, let's dive into this. To really understand the game, we first have to introduce the core concept of transfer pricing. Put simply, this is the price at which assets are transferred between related subsidiaries of the exact same parent company. Let's ground this with a real-world example. Imagine a massive cell phone manufacturer. Step 1. They produce computer chips in South Korea. Step 2. They ship those chips over to a subsidiary in Vietnam where the final phones are actually assembled. Step 3. Those assembled phones are shipped to a branch in India to be sold to consumers. And if you're curious, this exact supply chain mirrors what tech giants like Samsung do. But here's the million-dollar question. When that South Korean branch sends those chips to the Vietnamese branch, what price do they charge?
Well, the whole point is that setting this internal transfer price allows companies to shift taxable profits around the globe. Imagine South Korea has a really high corporate tax rate. The parent company obviously doesn't want to show a huge profit there. So instead of charging a high price, like $100 for the chips, they set a super low transfer price, let's say just $10. By charging only $10, the South Korean subsidiary reports barely any profit, maybe even zero, meaning they pay almost nothing in those high South Korean taxes. Meanwhile, the Vietnam subsidiary, which let's say enjoys a much lower tax rate, gets to buy its crucial components dirt cheap. When Vietnam finishes building the phones and passes them along, their profit margin looks massive. The end result? The parent company drastically lowers its overall global tax bill.
Section 2. The arm's length principle.
Now, obviously, national governments aren't blind to this. If companies could just arbitrarily set their internal prices to zero in high-tax countries, those nations would literally never collect a dime of corporate tax revenue from multinationals. So you have to ask, how does a national tax authority actually ensure they aren't getting completely played? How do they force these companies to follow the rules?
They do it using a foundational rule known as the arm's length principle. It's absolutely crucial. Governments use this standard to force companies to prove their internal pricing is genuinely fair and not just an elaborate tax-dodging scheme. Basically, the tax authority steps in and says, look, if you had sold those computer chips to a totally independent, unrelated company on the open market, what would they have paid? If the fair market price is $50, you can't just charge your own subsidiary $10 to avoid taxes. You have to price it at arm's length.
Which brings us to Section 3. Documenting the trail.
Now, proving that your internal prices are truly at arm's length, that requires a staggering amount of meticulous paperwork. Tax authorities demand a strict annual paper trail to verify everything, and companies have to comply to avoid devastating government audits. Most countries require 3 main documents. First, you have the master file. This gives authorities a big-picture view of the global organizational structure and how income gets allocated. Second is the local file, which drills down into country-specific intercompany transactions and justifies the exact pricing methodology the company used. And finally, the country-by-country report. This one is fascinating. It breaks down revenue, profit, taxes paid, and economic activity for each specific nation. If a government looks at this report and sees a massive amount of physical activity happening in their country, but a suspiciously low recognized profit, you better believe that's going to trigger some immediate and very uncomfortable questions.
Section 4. Avoidance rules and APAs.
Because the scrutiny on all that paperwork is so intense, companies and governments have developed formal truces to govern these high-stakes interactions. The most powerful one is an APA, or Advanced Pricing Agreement. Rather than sweating it out waiting for an audit, a business will proactively go to the government and formally agree on a transfer pricing methodology ahead of time. These agreements lock in a fair approach, usually for about 3 to 5 years. You can set up a unilateral APA with just one government, or go for a multilateral APA across several countries.
And that multilateral version is incredibly valuable because it prevents cross-border disputes, completely slashing the risk of massive penalties or, worst of all, being hit with double taxation on the exact same profits.
But governments aren't defenseless here. They have their own ultimate trap card. It's called General Anti-Avoidance Rules, or JAR. See, sometimes organizations come up with strategies that are technically legal on paper but completely violate the spirit of the law. JAR gives tax authorities the absolute power to override arrangements that are nothing more than deceptive tax avoidance schemes, lacking genuine economic substance.
Let's bring this right back to our cell phone company. Imagine they set up a subsidiary in a zero-tax jurisdiction, say some remote island nation. But this subsidiary has no employees and no real assets. It's just a shell company. Through some very complex transfer pricing, they somehow route all their global profits into this empty shell. Well, under GAR, the tax authorities can take one look at that and say, nope, this has zero real business purpose, it's just a trap, and they actually have the legal power to completely ignore that shell structure and tax the company as if the income was earned where the real work actually took place.
Section 5. Pricing methods and careers.
So, how do they actually come up with these numbers? Let's quickly run through the technical arsenal accountants use to negotiate acceptable prices. There are 5 main legitimate methods. Using real numbers, the cost-plus method adds a markup to incurred costs. So if a chip costs $50 to make and they agree to a 10% markup, the transfer price is $55. Simple enough. The resale price method works backward. If the final phone sells to a third party for $1,000 and a 20% gross margin is fair for the distributor, the transfer price is $800. Then we have the profit split method, which divides combined profits based on each subsidiary's actual contribution. There's the comparable uncontrolled price method, which checks prices directly against outside third parties. And finally, the transactional net margin method. The wild thing is, all of these are totally legitimate, yet applying different methods to the exact same supply chain can result in wildly different amounts of recognized profit. It gives accountants immense flexibility to optimize their employers' cash flows.
And because there are quite literally millions of dollars in tax savings on the line, transfer pricing has become an incredibly lucrative, highly specialized career path. Whether you're a corporate accountant focusing on cost accounting or a government auditor leveraging your public accounting experience, you are vital. In fact, there's a surprising warning often given to aspiring accountants entering this niche. You might actually have trouble getting promoted out of this field simply because you become way too valuable within it. That is how critical this knowledge is to both corporate accounting and government auditing.
Which brings us to our final thought for this explainer. We've seen the mechanics, the strategic shifting of profits, the strict enforcement of the arm's length principle, the mountains of paperwork, and the heavy-hitting avoidance rules. With millions of dollars constantly at stake, and highly specialized experts working furiously on both sides to leverage pricing methods and secure APAs, we really have to ask who is truly winning the global cat-and-mouse game of transfer pricing. It's a continuous, constantly evolving battle at the very heart of international finance, and understanding it completely changes how you view the global economy. Keep exploring, and I'll see you in the next explainer.